Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Nadek. There's often a tug of war taking place in financial markets between growth stocks and value stocks. When one outperforms, the other tends to underperform. That offers opportunity to investors who want to beat the market by riding the current trend or speculating on its reversal. Well, research from Vanguard suggests opportunity could be flashing for value stocks in 2023 and beyond, if history is any guide. So let's dive into the research to find out what drives the performance of growth stocks and value stocks, and what market conditions hint at what could be next for the pair. Joining us is Surenanthan Tharumakulasingam, Senior Strategist at Vanguard Canada. Thanks for being here with us today.
Thanks for having me, Jason.
Yeah, it's our pleasure, 100%. What do you think makes the growth versus value debate so relevant for investors today?
I think it's because no one's a clear winner, right? And so when there's a good rivalry in sports, and when there's a good rivalry in certain things in life, it just continues to go on. And I think we're now seeing that debate come back up because value, after kind of being out of favor for a while now, is becoming or emerging as more of the dominant investment style. So I think that's why we're still talking about it today.
Yeah, there's no doubt. Everybody loves a good rivalry. It always piques people's interest, and maybe beauty's in the eye of the beholder, even just a little bit here. All right, before we get into our conversation, I've got a quick trivia question for our audience. Which equity style outperformed from 1927 to 2022? Was it U.S. growth stocks or U.S. value stocks? We'll reveal that answer at the end of our conversation, so stay tuned. All right, let's jump in and get to it. Now, first off, let's lay some groundwork for our audience who might not be familiar with the differences between growth and value stocks. So what makes a company a growth stock?
Yeah, I think before we jump into it, it kind of talked about the rivalry, right? So there's almost this two sides of a coin situation. So at a high level, investors can think of growth and value stocks essentially inverses of one another. That's not entirely the case, but they're on different sides of the coin. And so when I'm thinking about a growth stock, it's really companies that tend to have rapidly rising revenues and profits beyond the average of the broader market. And so you're moving faster than what your peers are kind of doing. And so that can lead to a sharp price appreciation over time. Think about all the high achievers you had in school with you, right? The kids who just got all the questions right. And so a growth stock's a little bit like that. And so generally, they don't pay dividends. They increase profit and revenue at a faster rate. They end up having larger and larger market share. And then from a valuation perspective, they tend to be higher than the broader market. So when I say that, often the first thing I think about is something called price to earnings, right? So what's the price of the stock versus the earnings it's making? You can generally expect growth stocks to have a higher price to earnings. And a lot of that is because people are looking for the future growth in what's going to happen in a growth company, right? So you have to be a little bit of an optimist when it comes to growth investing. And oftentimes, if we're talking about certain growth industries, think about what's happening in the electric vehicle space. That's an emerging, growing space. Even artificial intelligence, it's really hard to get away from conversations outside of AI now. And that's kind of the main things that you would think about when you're talking about a growth stock.
All right, so we're putting some sort of faith in what we think is going to happen in the future, and what might be some of the other potential benefits to growth as well as risks to investing in that type of stock.
It's a situation really where the upside for a growth stock is that potential for outperformance versus the broader market. It's limitless, right? And so in that situation, you can get great returns. And so when you're thinking about it for an investor's perspective, I think sometimes growth is easier to understand than value, because we love to see how things get better and more and they improve over time. And growth stocks really are trying to capture that feeling. The downside to that, though, one, there's a little bit of that fear of missing out. So you get a higher price from the get-go, but with that price comes greater volatility. Just think about all the ideas you might have had in your life, Jason. Some of them are probably great ideas. They didn't pan out though, right? And so that's kind of this boom and bust nature of growth stocks, which does come with a little bit of volatility. And so as an investor, you have to be comfortable knowing that, it might not be an easy ride up, but if it does go up, it could be very fruitful for you over the long run.
What do we think about from like an investor psychology perspective? Like people always just think the market's going to go up. Does that kind of play into how growth stocks are maybe internally valued by some people?
when people say the market's going to go up, I think from a psychological perspective, it's easier to see that when it is a little bit of a straight line, like we see in the broader market. But any one growth name, that line may not be as straight, right? So we talk about certain names, and if you think about some of the names in the electric vehicle space, those stock prices went up and then down, and then up and then down, and so there's a relationship there that may not be comfortable for most investors at times.
All right, great explanation on growth. So let's look at the other side of the coin with value stocks. What makes a company a value stock?
Value stocks really are companies that, you think the share price is less than what they're actually worth, right? And so it's essentially trying to purchase something on a deal of some sort, right? My wife and I are looking for a house in Toronto, and I can tell you right now, it's very hard to find a value home in Toronto, right? It's probably more than what I want to pay. But when it comes back to value investing, there's instances that you'll see that are outside of your control, where a price of a stock might be lower than what you think it should be, and that could be maybe a disappointing business quarter, right? The company hasn't done what they expected. The uncertainty or the outlook of the business might be very different, right? So think about when we were going back to COVID, we're all working from home. That doesn't do well for certain automobile companies because you're not going to be driving as much. And so the outlook may have been a little bit weaker. And so that could have been value in nature. Or there could be just something around the management team or the strategic vision. Maybe the CEO likes to tweet a little too much, and that leads to certain issues with the company. So that's kind of where value stocks can have their nature of being valued a little bit less than what they're supposed to. And if you were to be a value investor and you were to hold on through what can be perceived as a tough time, that recovery in that share price can really help outperformance over a longer period of time, right? And so, and if I'm thinking about defining features of a value stock, um, to know that it's valuable, it kind of needs to be an established business, because if it's an unknown thing, it's really hard to put a value there. They tend to pay a dividend of some sort, so you're constantly getting some cash flow. And then going back to what I said, Jason, about that metric of price to earnings, in a value name, it'll be the opposite. So it'll be a lower price to earnings. So, the price isn't as expensive as what it's earning on a regular basis. And, sometimes you have other measures out there, price to book, but that's kind of how I would look at value overall.
So you touched a little bit on maybe like a little bit of underperforming from a earnings perspective. Is there a length of time that maybe a retail investor might look to see? There's been a trend either quarter over quarter or even annually of being undervalued from a time to time, or is that is there not really kind of a number we can apply to that in terms of length of time?
Yeah, no, that's a great question. What I would say is there's different types of value. There's relative value, and I think that's more short term in nature, right? And so if there's a bad quarter, that's relatively valuable compared to what you would expect it to be. And then there's something called deep value, which is longer periods of underperformance or longer periods of the stock kind of not being to what you think the intrinsic value is. Those two approaches of value come with different risks, I would say. Deeper value, there's a chance that maybe it isn't actually on a sale, maybe the company isn't good, right? And so that could lead to more downturns overall. And then relative value is what I would say is a tougher one to determine if that's a one-off quarter versus maybe that's the direction the company's now following.
All right. Thanks for the explanation. All right, we touched on benefits and risks for growth stocks. Let's do the same for value stocks. What are your thoughts on that?
Well, I think the benefit of value stocks is, and everyone likes a good deal, right? And so buying something on sale whenever the valuation is lower is great, because you have this view that it's going to go back up to what the market expects it to over a longer period of time. So there's an opportunity to recover and get some of a discount, right? Your early buyer kind of type of mentality. Like I mentioned, one of the characteristics that you tend to see, not always, but you tend to see with value names, is they pay a dividend. And so, from an investor's perspective, there's cash flow that comes in, and you kind of get paid for a recovery. They also they tend to be more established businesses, and so there's often less uncertainty or volatility that comes with value names versus something like a growth name, right? The risk, because that all sounds great, is kind of what I mentioned a bit ago, where it may be on sale for a reason, and so it might just be a downturn, and so you don't want to be catching a falling knife, so to speak, right? And so the stock price might be depressed and it continues to decline and it never actually recovers, similar to growth, where you may not meet up to your potential over the longer run. In value, you may not get back to whatever that um, intrinsic value looks like, and so that's kind of how you look at that from a risk perspective. And generally, Investors who have a shorter time frame, you can see the appeal to value because there's a dividend that comes with it. So at least there's some certainty. And so that's kind of how where we see certain demographics might tilt towards value over the longer run.
All right, thanks for clarifying the difference between growth and value stocks here. Now, as we mentioned earlier, growth and value tend to outperform each other at different times. Why would that be?
Yeah, so we were able to take a look at this right over a longer period of time, and really when we look at the drivers behind growth and value, it comes down to four things, right? So the first one is change in inflation, and so that's a very relevant topic right now. It's hard to avoid inflation, and so when you look at what happens when inflation's out there, and then there's a higher cost of goods and services, the money of the future is worth less than the money of today, right? And so if something's $2 today, it might be $4 tomorrow, and so you'd rather have, it's a good old adage, a bird in hand instead of two in the bush, and so that tends to lead well for value names because they're more established. That cash flow is more predictable. The idea of growth potential isn't as appealing because we're not sure what it's actually going to be valued in that point in time. So overall, inflation being the first driver, higher inflation tends to support value names. So that's the first one. The second one is growth in corporate profits, right? And so we hear about the market cycle and the business cycle. When there's a lot of business growth, that difference between a strong company and a weak company becomes a lot shorter, right? Or smaller. And so it's the saying, a rising tide lifts all boats. It's a good opportunity for everyone involved. And so you might think growth in corporate profits means it's going to be good for growth names, right? And so this is a part that's kind of counterintuitive, but actually it bodes well for value names instead of growth names in that instance, right? And I tell people the easiest way to think about this, and I bring everything back to sports, it's like thinking about a draft year in any sport you watch, right? Hockey or basketball or football. When there's a lot of talent, when there's a lot of corporate growth, as a team or as an investor, you're not going to extend to find one particular name because there's so many options there. And so value actually outperforms there. You're not putting an emphasis on overall potential. You're not going to draft a player that has great potential but doesn't really have an established basics of being a good player. And the same thing happens in this value growth situation where when there's a lot of growth in the market, there's going to be less of an emphasis on trying to find stronger growth names because there's just growth in abundance. And so in growth in corporate profits, that also supports value. Another thing that supports value is when the stock volatility tends to be higher, right? So that's the third factor, because value being a portion of the price being dividends, it's more consistent and it really allows for a investor to understand what they're getting themselves invested in. And so stock volatility is not really great for growth names, but it does provide a good opportunity for value names and then vice versa, right? So Jason, I've been giving you a lot of reasons where value works, but all those in the inverse help growth. So low inflation helps growth. Lower corporate earnings actually help growth, and lower volatility help growth. The last thing, and it's tied to inflation to an extent, is bond yields. Generally, investors are less willing to invest in a growth name when bond yields are high because there's certainty in buying a bond instead, right? And so that comes off with this trade-off. Essentially, you get lower risk, so why would you go into growth names? And so a higher bond yield, similar to what we're seeing right now, tends to actually support value names overall. So those are the four factors I would consider, right? Change in inflation, growth in corporate profits, stock volatility, and bond yields.
So, given these findings and those factors, which sort of market conditions generally tend to favor growth stocks and value stocks?
Yeah, that's a great question, and I think the first thing we just need to appreciate is um, I mentioned those four things that have driven growth and value. There's one part that is really hard to really to study, and that's just human behavior, right? Investor behavior, and that's the last part of it. So the stock market tries to be forward-looking, and so there's a component of this where we're trying to predict the future based off today, which doesn't always work out. I remember during COVID, my wife had told me I don't need any of my suits anymore because I'm never going in the office. I'm glad I didn't sell my suits because I wear one every single day now. So it's really hard to predict that in that longer term view. But overall, when we're looking at what markets tend to do better for growth or value. Historically, growth stocks had tend to outperform during economic slowdown and contraction, right? Why? Because if I'm thinking about the four factors, that tends to be lower inflation, that tends to be lower interest rates because the central banks tend to cut rates at that point. And so this might seem counterintuitive, but investors are now prioritizing investing in companies that they expect to grow beyond this tough economic condition, right? And so it's harder to find companies on sale, but it's also trickier because that sale, kind of what I mentioned, it might actually be the real price going forward. And so the recovery is no longer there. And so in those situations where there's economic slowdowns and contractions, it tends to support growth names. Historically, value names tend to outperform when the market recovers. Going back to a growth in corporate earnings, the market's doing better, value names are more abundant, and so people are more likely to invest in something that's a little bit more bankable in that situation. And so this is in part to investors realizing that interest rates may have been cut and there's less of a fear for dividend cuts to happen now. And so the companies that they're investing in, they're still going to continuously pay dividends. And so there's a recovery that's being seen there. And so that's kind of an economic cycle where it would favor value names. With all that said, like I said, the economic cycle can be unreliable on its own. And so investors kind of need to look at the broader context of the market when it comes to both value and growth names overall.
It's advocating for kind of zooming out, taking like that 10,000 foot kind of a view approach, but not losing focus in sight of what's actually happening now. Is that kind of what you're saying?
Exactly. Yeah, exactly. Yeah.
All right,
And
great.
to say that those are the four factors that drive it, but that doesn't necessarily mean it will always go a certain way, right? Because if it were, Jason, to be honest with you, I probably wouldn't have this conversation. I'd be on a beach somewhere, and so there's that component of as well that we have to keep in mind.
Yeah, I was having the same thought. We could share a daiquiri together or something if it's just that easy, right? So
Exactly. Exactly.
all right. Well, interestingly enough, value stocks have historically outperformed growth stocks from 1936 to 2011, but then a strong reversal occurred and growth stocks widely outperformed. What caused this sudden shift?
Yeah. So in this case, what we saw when growth was outperforming value, there's a lot of secular factors supporting growth stocks, right? And those are the conditions that kind of hurt value stocks overall. One was these factors of technological advancement, which made producing goods and services a lot easier. So when we think about inflation, there's two reasons for inflation. Either the demand is so high that people are willing to pay more, or the supply is so scarce that you're paying more to have it. Technological advancements, they essentially keep that supply being scarce situation out of the picture. And so it was a lot easier. The supply was more abundant. And so that really helped growth names overall. It also meant that the growth names that provided that supply were able to outperform their peers. And we talked about the four reasons, but in that period that you spoke about, it was historically low interest rates, right? Which made the cost of finance a lot cheaper. And so companies were able to take, I'd say swings for the fences a bit. And so that allowed you to have a little bit more investing into your company and growing because you didn't have to be as prudent with your money because it was easy to get more money. When interest rates are higher, that becomes a lot harder. And I think we're kind of in that place right now. And the last thing, when you put those two together, inflation and technological advancement, there's this other thing where inflation was kind of low overall. And so going back to those four things that help growth names, all of those factors were in play. And so that's really where growth was able to outperform value in that period of time.
All right, interesting. All right, so we've looked back in your last answer. Now let's take a bit of a current view. What do current market indicators suggest to you about the which of the two might outperform in the years ahead?
Yeah, I think there's a few things, right? So when we look at the aspect of this idea of reversion to the mean, right? So between value and growth names, growth was outperforming value for a very long time, and really it was those secular trends that allowed for it. Those secular trends are no longer there now, right? And so, we really do think there's an opportunity or a potential for value to kind of catch up to where growth was. And so whether it's growth or value stocks, when they become overvalued relative to the other, investors start to see opportunities to move to that unloved investment style. And we started to see that a little bit more. And it might be the same investor or the preferences change, right? And so in a low inflation, low interest rate world, growth made a ton of sense if you wanted that volatility. Now in a higher inflation, higher interest rate world, value becomes a little bit more loved. And so we've seen that over a longer period of time. We saw this dynamic kind of in 2020 during the pandemic where growth was overvalued during the lockdowns and then started to outperform growth, and we're kind of seeing that potentially continue going forward. And so I think the chart that we're showing here, this gray area, indicates the high and low range of fair value between value and growth stocks. And so when that ratio is above the high end of the range, growth stocks are usually expected to outperform, and when that ratio is below that low end, that's when value stocks tend to outperform. And so that's speaking to a few things that we're trying to summarize from our conversations. I mentioned mean reversion. That's not the only factor. It tends to usually go hand in hand with all the economic drivers around there. But based off that, that's where we really do think value has a potential to outperform growth over the next little bit.
All right, and going back to something you mentioned previously, the economic cycle can play a meaningful role in driving a stock's performance. What developments might support an outperformance in value stocks here?
Yeah, so if we look at history as any guide for this, I think the case for value stocks is really going to be strengthened if the global economy will start to recover strongly out of a recession, right? And so, as I mentioned, value stocks tend to outperform in those scenarios as corporate profits improve. And then also, when we look at the longer term dynamics, what would support value outperforming is just inflation being that 2 to 3% annually, so a little bit higher than was what we saw over the longer run, and also interest rates also being closer to historical averages, around 4 or 5%, not the world that we were in when interest rates were non-existent. And so I think if you take those things into consideration and that economic cycle, that's really what would help values outperformance over a longer period of time.
All right, so we want to be balanced here, so I'll take the opportunity to play devil's advocate here. What might derail the expected outperformance of value stocks?
Yeah, it would almost be the inverse of that, where the global economy starts to stall and decline further, right? Than recover. And so, growth stocks, like I mentioned, they outperform in scenarios where corporate profits weaken and inflation and interest rates remain low. So let's say things got a lot worse and we have to really start cutting rates at a faster pace. That will tend to bode well for growth names. And then so that's the one thing to look at. And then also when you're thinking about just overall how companies are going to reinvest into their research and development at higher valuations, this tends to support growth stocks when they tend to devote a greater resource to R&D. And so lower interest rates allow that a lot easier than higher interest rates because the cost of finance is a lot more bearable for those names.
Yeah, that makes sense. Now, so we've talked a lot about growth and value stocks being two sides of a coin, but investing in them isn't always either an either or situation. How might an investor want to consider striking a balance between the two?
Yeah, in my opinion, and Jason, as you know, I work for Vanguard, so diversification really does matter to us across both asset classes. But you can make the case for having diversification across both growth and value names, right? Because, like we talked about at the start of the segment, the debate continues because there's no clear winner, and so there's no real superior style of investing and outperformance for growth or value. And so I can see investors outweighing their portfolio to either growth or value depending on their view of the economic cycle. But that's a tough one to play, right? I think if we can get macro calls right often, again, we would be on a beach having daiquiris. So that's kind of where I think diversification really comes into play here. But in my view, it's important for investors to consider investment time horizon and your risk tolerance. I think that will help determine how much of your portfolio should be more growth and how much of your portfolio should be more value. And if you have a longer investment horizon and you are comfortable with a little bit more risk, I can see you leaning towards growth. And if it's the opposite of that, if you have a lower investment horizon and you have less of a risk appetite, I can see you leaning towards value. But a combination of the two will probably help you over the long run.
So we've talked about kind of getting diversification through the exposure to both stocks. Is there ever a time when like a single security might be like a value growth stock, like some sort of combination of the two?
We constantly have to check ourselves for what those definitions are, right? And so there is going to be a point in time, and that's a great question. There's going to point in time where a company, their priority is not to spend all their money in reinvesting and to slowly pay back into their dividends or pay out dividends to their shareholders. And so you get that kind of growth value blend, and that's essentially an established name that's been around for a very long time that still has a presence in research and development, but are slowly starting to pay dividends. Think back to the early 2000s. There were a lot of companies in the computer space or the computing space. They were growth names then. 23 years later, they become a little bit more established. They're still growing and pushing the edge of innovation, but now they're starting to see a little bit more of a consistent dividend being paid, right? It's tough to find that. It's a little bit of a unicorn, so to speak. And so that's where I think if you diversify across different types of names, you could probably balance it out more than just trying to find those names that are still have that growth characteristic, but some value characteristics as well.
Yeah, the word unicorn is always going to pique everyone's interest, whether or not it's investing or if we're back to a sports analogy. Yeah,
Yeah.
if you find that unicorn, you're probably doing all right. So,
Yeah.
all right. And just a quick reminder to our audience, if you want to learn more about building a diversified portfolio, check out our webinar, Why Your Asset Allocation May Need a Rethink. It's available in the Learning Center on Webroker and on TD's YouTube page. Okay, and we've heard a lot about the difference between growth stocks and value stocks. Now let's take a moment to hop into Webroker to show our viewers how they can screen for growth stocks and value stocks and other factors to consider. Let's jump in and learn about the screeners tool here in Webroker so we can begin to help identify value and growth stock opportunities. To start, we're going to choose the Research tab from the top of the page. Then under the Tools column, we'll select Screeners. Now, on the Screeners page, we have the ability to screen for different stocks. We can screen for technical events, as well as mutual funds and ETFs. We're going to stay right here on the stocks page. The first thing I'd like to show everybody is our preset screen. Here conveniently in the preset screen, we have a value stock opportunity already preloaded for everybody to use. If we hold our mouse over any of the preset screens, a description of the screen comes up. All right, to begin using this particular screen, we'll just go ahead and click on that box, and the screen appears right here in front of us. If you'd like to learn more about what's contained in the screen itself, you'll notice there's a bulk edits toggle switch up in the top right hand corner. If we go ahead and switch that on, it goes ahead and shows us exactly what criteria is contained. If you wanted to learn more about any one of the criteria of the screen itself, you can hover your mouse over the individual information buttons, and that'll tell you about that specific criteria, so know exactly what you're trying to identify in the opportunities found here. Now, one of the nice things about the preset screens is that they are customizable as well. You can go ahead and remove any of the criteria listed by clicking on the trash can on the right-hand side. Additionally, you have the opportunity to click on the bulk edit button and you'll be able to go ahead and add additional features that might be to your liking. All right, so that was the presets. Now let's go ahead and create a screen right from scratch containing some of the valuation metrics that were in our discussion with Surenanthan. So let's go ahead and clear this screen away. And I'm going to go ahead and click on the More Criteria button. And this is going to bring up a whole wide list of the different criteria that you have at your disposal. The first one I want to go ahead and select here is our PE option. The price to earnings ratio is something that was discussed in our conversation. Understand that growth stocks may have a larger PE and value stocks may have a smaller PE. So we can go ahead and add that on. Now, if you want to add additional criteria, you have the opportunity to either scroll through the list that's at the top of the screen, or you can go ahead and once again click on the More Criteria button, and that's going to bring us back to our selection page. We added PE already. Let's go ahead and now add in price to book. Once again, another topic of conversation that we addressed later. So we have that available for us to choose. One last thing that I'd like to add in is specifically if we're looking for value stocks. We talked that value stocks might, in some certain circumstances, pay dividends. So we can go ahead and add that criteria to our screen by under the dividend section choosing dividend yield. So this is the percentage of the annual dividend paid back to shareholders in relationship to the share price. So we've got those three fields filled in for us, you also have the opportunity to really narrow down where you're looking for your stocks. You'll notice that we're looking at both US and Canadian markets. You even can choose specific exchanges that your investments are listed on to really narrow the funnel down. I'm going to go ahead and choose Canadian just for this particular purpose. You'll notice that the total will drop from over 1,600 to 287. So just with these three simple fields, we've already started to narrow down our results. And if we scroll down, the results are preloaded right below our criteria. We'll notice that we've got all of the different selections available to us. If we want to learn more about any of these particular companies, we can go ahead and click on them. It'll give us an overview and how they stacked up with our specific criteria. And then ultimately, we also do have the choice to really dive in and get more information by choosing the drop-down menu on the right-hand side. We can begin our trades. We can begin to get more information by choosing the overview. And we can even do a little of additional, maybe some technical analysis using our charting function right here in the platform. All right, the last thing I'd like to leave everybody with is a little additional learning opportunity. I'd like to direct everybody's attention to the search field at the top of the screen. If we go ahead and just click on that, and then from here, go ahead and type in screeners. It's going to bring up all of the different videos that are going to be essential to learning about this really comprehensive tools. The first two that I would really recommend watching. That's Find Your Next Trade with Screeners, as well as How to Sharpen Your Search with Custom Screens. Both great opportunities to really make sure you're getting the most out of this really beneficial tool. All right, now before we wrap things up, let's reveal the answer to our trivia question. As a refresher, the question was, which equity style outperformed from 1927 to 2022? Was it US growth stocks or US value stocks? And the answer is value stocks outperformed growth stocks in the US by an average of 4.4% from 1927 to 2022, according to research by Eugene Fama and Kenneth French. However, more recently, history has been kinder to growth stocks. An analysis by Y-Charts found the average annualized 5-year returns for both styles are nearly identical from 1984 to July 2023. Surenanthan, what's your opinion on that?
Yeah, like I said, I think we expected over a longer run that they would kind of net out. So it's it kind of in line with my expectations. But I could see a lot of people being shocked by that, just because we've seen a lot more investors over the last 5 years, and those 5 years, with the exception of last year, was kind of dominated by growth names. So I think it's an eye-opening trivia question, just because. Otherwise we would just be growth investing all day, right? And so there's an opportunity to see the other side of the coin here.
Absolutely. All right, we're going to have to leave it there. Surenanthan, thanks for filling us in on key factors that drive the performance of both growth and value stocks. Do you have any final thoughts you'd like to share with the audience?
Yeah, I think it really just the importance that no one style of investing is going to be the right style, right? It changes over time depending on your risk tolerance and really your appetite for your time horizon of investing. A while ago, I used to be predominantly a growth investor. I think I'm starting to see the value in value as well. And I think as things happen in your life, whether you just get older or you just have different milestones, it's always prudent for investors to think back to their risk tolerance and their investment horizon, and that can really change over time. So just because you're a growth investor today doesn't mean you always have to be, and just because you're a value investor doesn't mean you always have to be. There is a benefit to have both.
All right, that's some great guidance. And thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see you all next time.